Hi, it's Bob with Top Choice Real Estate, bringing the word on the street, talking Indiana real estate. Today I'm sharing number one, what's been going on in the local market, and number two, what we might see happen with prices and rates in 2025. Hey, and number three, what you might do about it, like to be successful. Hey, stick around and I'll share some secrets I learned during my 17 years in the mortgage end of this business. Okay, looking at real estate activity in the central Indiana market during the month of November, average sale prices are sticking right around that $300,000 number. There were 2,232 sales this past month, and that is pretty much flat year over year. The typical home sold in 23 days compared to 20 and a half days a year ago. So just a little bit longer time on market average. You kind of put that all together and the homes are selling at just, maybe a 2% discount from list price on average. So that $300,000 home, it's selling for about $294,000. There's 4,849 homes for sale in central Indiana, and that number is up 8% from a year ago. And hey, that's good, but not great. We still only have 2 months of inventory for every buyer, and really we'd like to see that at about 5 or 6 months. So hey, things are getting better, but kind of slowly. The inventory remains tight. Hey, moving along, the housing analysts at Goldman Sachs, they expect mortgage rates to move just a little bit this coming year, kind of in the low to mid sixes. They're also expecting home prices on average across the country to remain somewhat at the current level or maybe to increase slightly. That bodes a kind of tough road to hoe for many buyers across the U.S. Mortgage lenders would like to see people spend about 30% of their gross income on their housing payment. Now, if we look across the country right now, in 24 states, the average monthly house payment is over 40% of the median income. And 8 states have payments that are in the 35 to 40% range. By the way, Indiana is one of the better states. It has a median house payment that's right around 31.8% of median household income, which makes it most affordable states, and it's pretty close to the ideal range, that 30% number. So let me ask you a question. With rates being what they are, how do you select what kind of mortgage to get? Hey, insider tip. There are more options than the 30-year fixed rate mortgage. So the first question is, fixed or adjustable? Fixed means that payment and the rate are going to stay constant for the entire term of the loan, like 30 years. Now that's great if you're going to keep the mortgage for that time frame. Notice I did not say how long you're going to live in the house. That's because many people change mortgages while they're still in the same house for one reason or another. Think, get a lower rate, pull cash out, fund home improvements, move equity to a higher performing investment, or any number of other reasons. So, once again, fixed rate mortgages are great if you plan on keeping the mortgage for the entire time you signed up for. Now, adjustable rate mortgages, or ARMs as they're referred to, many people are afraid of them. But let's take a look and see if they might be a useful financial tool for you. ARMs take many different forms. You can find ones that change every 6 months, every year. Maybe they're constant for 3, 5, 7, even 10 years. And the start rate is almost always lower than a fixed rate mortgage. So if you think rates will be moving lower, or maybe you plan on moving in the next 3 or 4 years. Or, hey, you want to change your mortgage for one reason or another. Maybe you're going to get a big bonus or an inheritance, or, hey, I don't know. Life happens, you know? So if you think one of those things is likely to happen within that first period of an ARM, like the 3, 5, 7, 10 years, then using an ARM may help you secure your financial goals better or quicker. Because remember, that interest rate, that start rate, is going to be lower than the fixed rate mortgage. Okay, another question. What term is best, 15 or 30 years? Yes, the 30-year fixed rate gives you a lower monthly payment, but drum roll, on a 15-year fixed rate, you build equity in half the time. It's like a forced savings account. And you get an added kicker because the rate on the 15-year is lower than on the 30-year. So you have a stronger financial tool to work with. And if you sell the house after, say, 7 years and you're on a 15-year, you'll have built up a considerably larger savings account. And hey, if you do that a couple times, you just may own your home outright. If you're considering relocating to the Greater Indianapolis area or moving anywhere within central Indiana, be sure to tune in every week to learn all there is to know about real estate and living in Indiana. Whether you're buying or selling, please keep in mind, I work harder to make good things happen. Hey, make it a great day now. And if you found this video helpful, be sure to watch this next clip right now.